Hello and welcome back to Almus Market Mornings, folks. Your daily dose of global financial update with your host Shikhar Garg. Now, it's good to be back after some hibernation, with fresh perspectives, just like how markets move in uh, these days. Now, talking about perspectives, I remember Nasdaq dived almost 30% on the onset of COVID and lockdowns, and this is something similar that we have observed. Nasdaq dove 30%, almost 30% from the peak this time, though due to policy tightening, geopolitics, and inflation this time. So uh, I see a lot of things going around in the financial markets. JK, what new perspectives can we talk about this time?
Hello, good morning, all. So Friday was a very important day because markets start to assess where the U.S. economy is going, and particularly on the employment front. The lead up to the jobs report was quite poor. Jobless claims were somewhat higher. The employment component of the ISM data was also negative. New job openings had come down, and the private jobs report, the ADP numbers that came the one day prior to the NFP, also was poor. But still, the NFP actually surprised to the upside, coming at 3,90,000, and the unemployment rate steadily at a low of 3.6%. Wage inflation was rising again at 0.3%. So it was a strong report in all respects, and market had actually gone into the report expecting that it will be a weak one, and there will be some support for the risk assets. That was not to be, and markets actually went down, although not necessarily because of the strong jobs report. I would say markets had seen a good recovery in the last 10 days, particularly the Nasdaq, which had almost fallen 30%, like Shikhar mentioned. From there, it had recovered almost 10 to 11%, and it still stays in a bear market. So the bear market rally was reversed on Friday. Jobs report, serving as a trigger. The underlying reason for markets to be underperforming is inflation still remains high, and the Fed rate hikes are very much on the cards in steps of 0.5% in June and July. More importantly, additional people are now thinking that a hike in September of 0.5% is also possible, which is quite contrary to the belief that was emerging that there may be a pause in September. Mester, one of the Fed members, also said that unless there is a conclusive evidence of inflation turning, she does not see change in the Fed's rate hike path even in September. So that actually pushed the yields higher. 30-year now stays well above 3%, and then 10-year is closer to 3%. So that is actually a sell-off in the bonds, and the stock market, as I said earlier, reversed some of their recent bear market rally, and we saw Nasdaq falling almost 2.7%. Now, more than that, we also had corporate America's concerns being expressed about the US economy, which actually had an impact on the sentiment. Like Tesla shares fell by 9.2% after Elon Musk, in a mail to Reuters, said he's had a super bad feeling about the economy. A mail seen by Reuters said he had a super bad feeling about the economy and needs to cut about 10% of the jobs at the company. Apple's share fell by 3.9%, which is not very big, but more importantly, we saw a big technical breakdown in the Apple share chart, where we call it as a death cross, with a 50-day moving average coming below the 200-day moving average. Then we also had Jamie Dimon of JP Morgan calling for very tough time ahead, and so that was leaving a very bad sentiment in the market. So that sentiment has been actually carried over into the Asian market as well. We start the week, which is going to be full of again big economic events. We have Australian Central Bank rate decision tomorrow, possibly no change, but then they remain hawkish. We have our own RBI meeting, which will conclude on Wednesday with a policy rate hike possible up to 0.25%. Then we have ECB on Thursday, and whether they would surprise by hacking in June, or they will announce or rather indicate to the market of a up to 0.5% hike in July. These are questions in the mind of the investors. And then we have trade data from US, which has been having a big influence on the US GDP. Finally, we end the week with the CPI report, again showing some moderation in the headline number, but staying well into the decade, multi-decade highs. So we are into a week with a slightly weak sentiment and a cautious sentiment. And dollar itself has not shown much of a reaction despite the risk sentiment taking a hit, because euro has been holding on to its recent gains in anticipation of a hawkish turn or the hawkish statement from DCB at its meeting. And with euro remaining strong and commodity currencies also helped along by stronger oil prices, we are having not so much of a reaction by dollar despite the jobs report being quite strong. Chinese yuan and Korean yuan on the Asian side have also been quite steady after gaining about 4 to 5% in the last few weeks. So that's a setting for the dollar. But come to India, none of this is having an impact on the rupee, because most of the influence for the rupee is coming through higher oil price, and which has gone into 120 plus after the recent European decision to ban oil import from Russia. But the trade number that came, the preliminary report, was not could not have come at the right time, could not have come at a bad time rather, because it showed trade deficit soaring to 23 plus billion for the month of May, and which is way ahead, way higher than the last 6 months average of around 20 billion. It puts, at this rate, our current account deficit is going to cross 3%, and BOP is in all likelihood going into the negative as long as the oil stays at 100 plus levels. So the market's concern on the rupee remaining stable so long as RBI is supplying dollars is real, but then we do not know how long they continue in the face of higher demand on the forex kitty, because of the huge gap that is emerging between the demand and supply. So the underlying trend for the rupee is still to weaken. It may be postponed because of the efforts of the central bank. Maybe in the short term, until RBI's meeting is over, we might have the steadiness contained. One should also remember that it was last hike by RBI in May, the intermeeting hike of 0.4%. That was the time when the dollar rupee actually jumped. So market will be quite aware of what is the inflation forecast going to be by RBI and how much they meet by way of change in the policy to to rein in those inflation. So rupee is in a different world. Dollar overall steady, but risk sentiment is going to be poor and cautious going into the new week. So that's it. That's how we start the week. Thank you, all of you.
That was quite good, JK. I mean, yes, there was some bit of a surprise on the oil price front. I mean, with the OPEC did talk about the supply acceleration, but at the same time, I see Saudi has hiked the OSP for Asia. The premium that they charge for selling oil in Asia. Plus, the event full week is also in the ongo. We have RBA, MPC, ECB, trade data, CPI. So there's a lot of updates coming in front of us this week. Rest assured, we'll have some good movement, I think, over the coming 5 days. Also, we have RBI's MPC, which is much more significant, as I mentioned earlier. So let's see how we have our central bank acting against the kind of updates we are having in the financial markets on Wednesday. Till then, we take goodbye. It was good coming back. We'll catch up again tomorrow. Thank you.